In essence, what you're saying is that there's a clause under the compensation section of the purchase agreement that determines that a portion of the total buyout price will actually be received as an additional payment in the future based on the future performance of the business.
Hello, everyone. Welcome back to Cashing Out, brought to you each week by Hoban Law. With me today in the MJBulls studios, as always, is my co-host, Dena Jalbert from Align Business Advisory Services. Hey, Dena.
Hey, Dan.
And our legal advisor, attorney Larry Mishkin from the Mishkin Law and Hoban Law. Hey, Larry.
Hey, guys. How are you?
Doing well. Dena, you were right when you said that things were going to start ramping up after the 15th. There's a lot more interest in our deal.
Yeah. We had a bit of a light switch. It was great.
Yeah, it's nice. I wish the buyers were more interested in being public. We're having a really hard time getting them to want to discuss the deal on the podcast.
Yes. Well, maybe what we can do is after the fact, get them to do a postmortem.
Oh, that's true.
Oh, I like that.
Yeah, that's a good idea. Are you surprised that they're playing it this close to the vest?
It's something we see in this industry. Everybody's, racing to be the first in their strategies. They're all trying to keep very undercover and in stealth mode, where we see it in a lot of deals, really heavy NDAs, which is great. But so sometimes they don't necessarily maybe want to be public because they don't want to let the guys down the street know what they're up to.
Well, I wish they would, but like you said, that's a good idea. Maybe we'll do it afterwards and we'll have them come in and talk to our listeners about what they were thinking about during the early parts of the deal. Earlier this week, Dena and I had a call with a potential buyer to discuss the deal. And during the call, they were asking me about what some options of compensation or what they'd use to purchase the company. And in the discussions, they said, would you be comfortable with cash and stock or an earnout? And I'm starting to hear that more and more from a lot of our guests on our show when they're talking about deals that they're in the middle of, where there's multiple methods of compensation. So I thought we'd use today's show to break down each form. Yeah, maybe explain the pros and cons of each, if you guys are up for that.
Awesome.
Yeah. Why don't we just start right off with an earnout? What is an earnout, and what's the upside? What's the downside of an earnout?
Well, that's a good question, Dan. And it's one that I think that people really, really do need to focus on very carefully when they enter into these types of deals. And part of it is really knowing what you're looking for and what you're really hoping to try to accomplish. And what I mean by that is, are we looking at a situation where somebody's selling because they're in a cash flow crisis, they need cash, they need the money now, and this is the asset, their business that they have available to sell? Well, in that case, an earnout is not something that's going to be particularly popular for them, because an earnout has a potential for a high payout, but also has a potential for a much lower payout. So it takes a high risk tolerance. In essence, what you're saying is that there's a clause under the compensation section of the purchase agreement that determines that a portion of the total buyout price will actually be received as an additional payment in the future based on the future performance of the business. This is typically done when the seller is going to be sticking around and having some role in the business going forward, because otherwise you're gambling part of your payout on somebody else's performance. However, even if they keep you on board and say, Dan, we're going to keep you on board, what an earnout might say is that if you hit a certain EBITDA number in the following year, then your earnout will pay you X. And then if you hit yet another EBITDA figure the following year after that, then it will pay you Y. And it'll give you the option as you go along up to a certain point. So, for instance, let's say on paper the total purchase price is $5 million. They're going to say, we'll pay you $425,000 in cash up front. And the rest of it will be paid to you by way of an earnout over a 3-year period. And as long as you hit these EBITDA targets each year and you max out on what your earnout can be, then you will in fact have received $5 million. If you don't hit all of those earnout numbers, your number could be as low as the 450 that they give you, or possibly somewhere in between. Yeah. So what they'll come back and say to you is, alternatively, if you just want a straight cash purchase, then we're only going to pay you $1.5 million for your business.
Right.
So with cash, you have the certainty of knowing that you've got the money, but because of that certainty, typically the purchase price is reduced over what it could be in an earnout scenario.
Do you run into that a lot, Dena, with deals that you're doing?
Yeah, absolutely. Most of our transactions that we see, there's always an earnout component to mitigate risk for the buying entity, but also to provide some upside for the selling entity. And it's always, Larry, you said it very well. One of the questions we ask Dan this too, and a lot of our clients is, what's your personal motivation in this deal? Are you going to roll your money into a new venture? Are you going to go retire in Costa Rica? Are you going to go buy real estate? Whatever that is, whatever that motivation is it's important to know it, because then, defining an earnout and defining the timeline and transition is key to that, because you don't want to sign up for 3 years if you want to, go cash out and lay around on the beaches in Tahiti.
Yeah. Sounds good right about now here in Chicago.
Yeah, exactly. So we see it often, and but it also, on the flip side, provides really good upside. So for those who are willing to stick around for a couple of years and know that you can work together with the buying team and there's synergies there, and you have the ability to grow it, you could earn tremendously more in some cases. So it's a common mechanic. You just have to have good attorneys like Larry here to be able to, structure it and word it and define it in the right way so that everybody wins.
If I just came close to the number, is it a lower percentage, or is it like one of those deals, all or nothing? If you don't get this, then you get nothing. It's both?
That's a negotiated point, and that's a great question, Dan. And that's a strictly negotiated point. I've seen deals where they say either you hit the number or you get nothing. Other times we've been able to negotiate. Typically, you'll have to hit somewhere in the neighborhood of 60 to 75% at a minimum. They're not going to give you a payout for hitting 30 or 40 or even 50%. And usually what we're really pushing is, if we get above the 80% range, because what happens at that point in time, and this is the negotiation tactic that we use, that even though, Dan, they're keeping you on and you're there, to make sure that the business performs at the levels it's anticipated, it's not your business anymore, and you're not calling the shots. So you can't, unless they're going to give you total control of the business to run it. But a lot of times they don't want to do that. So now you have to worry, what if they decide we don't want to put quite so much money into this particular aspect of our portfolio? We're going to throw some more money over here. And it just so happens that during the 2 years of your earnout, just so happen to be the 2 years that they've put the lowest amount of money into this side of their business now. Maybe that's being done coincidentally. Maybe that's being done intentionally. It's a tricky situation. And that's why we usually like to try and build some cushion in, and we do it without accusing anyone of anything. But we do it to say, look, it's just, if we get within 80%, then there should be a payout of some sort. And that kind of removes the issue of, do we have to worry that, I think, Dan, when you and I were talking earlier, it's like if a player signs a contract and they have a performance incentive, and then the team doesn't let him perform, or they change their strategy, so his skill set is no longer required. And that's the same thing here. You just want to be careful that they can't totally remove all of your future earning potential just by, what they might claim later on, or, hey, these are reasonable business decisions. We just had to do it this way.
I see. Okay. Let me take a quick second and do a little business and thank one of our sponsors, Trevitt Hill LLC. Cannabis investors expect the companies that they invest in to generate really big returns. Unfortunately, not all companies reach their expectations. Trevitt Hill's management team works with investors to turn around and in some cases purchase their underperforming portfolio companies. To learn more, go to trevitthill.com. Well, let's switch gears and talk a little bit about somebody using equity or stock in their company as another form of compensation. We've touched on it in various shows, but let's just really dive into it for a minute here. What does that mean when somebody says, I'm going to use my stock to purchase your company?
Yeah, so sometimes we see it in deals. It can come in two forms. One, it can be your issued stock certificate, and there's usually a defined value to them. And it's essentially, you may get 50% in cash, 50% in stock. Well, whatever that per unit or, per share price is, you get, X amount of shares that equals the other 50% of your purchase price, that value. And that can be attractive if you think that that's a growing business and that stock's going to appreciate and get you an upside and more value beyond the multiple in the future. It can also have the adverse impact too. If it goes down, there's always a downside risk with that too.
I completely get it. If it's, I don't know, Ford wants to give me stock in Ford Motor Company, and then I would have stock in Ford, and that makes complete sense. But what about if it's, say, a venture capital fund or private equity group?
In that case, they usually have an operating company that is owned by the portfolio, or the funds from the portfolio were invested into the operating company that, essentially acquires businesses or makes investments. And you would traditionally get shares in that. That's historically been our experience. And it goes the same with even a private company. It doesn't always have to be a public company, or a private company similarly can issue those things. It tends to be, in that case, an equity grant as an employee, equity compensation versus proceeds. So that's where stock can come into play, and kind of in two places. You have to be very specific about what it is, what it's valued at, and what you think the upside potential is or isn't, as to whether or not you're comfortable in getting that stock. But the idea is that you're given those stock shares, and you hold them for 5 years, and they're worth 5 times as much as they were on the day of closing. And so for that 50% of your purchase price, you earned 5 times more than you would have if you just took cash.
I see. Do you run into this a lot with deals that you're structuring, Larry?
We do. And I think that description by Dena is very accurate, overall in terms of how it works. My concerns with equity is this, in this industry, especially, and I think it's kind of like the way the big tech industry was when it was, going through its meteoric rise and everything. Giving equity is easy. I'm going to give you a piece of my company. It means I don't have to put up cash right now. And quite frankly, for that person, it's a great deal, because if the company succeeds and you get paid, that's fine, because they're going to be getting paid a lot more. They're going to own a lot bigger chunk of you. So, they'll gladly have you earn your amount that you earn. And similarly, if the company falls on its face, oh, well, it was a bad gamble by you, and they haven't really lost out on anything. That's why, anytime there's a new company, if I could actually be compensated for all the people in the industry who have offered me a piece of their company, if I do their legal work for them at no charge, I would be somewhere warmer than I am right now. That's never really been the option. So I think that what you really have to do is you have to look at it very carefully. And what are they giving you stock in? So, if it's just you and you're selling this business and they're buying it from you and they're going to give you stock back in the business, my question to you is why? Do you think that they're going to be able to run the business that much better than you were able to? Keeping stock in a business that you've decided is appropriate to sell is really a good thing. The alternative, though, is if you're being purchased by a company, an entity that owns a lot of other companies, right? Now, if you're talking about getting stock back up in the parent entity, then it might very well be worth it, depending on which parent entity you're talking about and how it's doing at any particular time. And then kind of what you're saying is, look, whether this particular business rises or falls, at least I'm getting a piece of stock in the larger picture. Now, they're obviously reluctant to give away too much of that stock. So it really kind of becomes a negotiation back and forth. And I guess where I would say, for somebody in your position, Dan, that it would make the most sense is if, they're really giving you a tremendous opportunity in a company that you've checked out and you believe this is exciting and this is worthwhile and I really want to be a part of it. Then in that case, you can kind of say, yeah, this might work for you. If it works because, you've gone through a bunch of buyers and nobody's been able to pay you out at the price you're looking for, and somebody says, well, look, I can get close and I'll give you some stock options, then that might be better than no deal at all, right? But in a stock option deal, just like in a earnout situation, there's still a level of risk involved in terms of not only are you going to get paid, but when are you going to get paid? And actually, let me just throw this last little point in there, because Dena made a good comparison of public to privately held companies. If they're giving you stock in a public company, that's one thing, because typically public stocks don't have transfer restrictions. But if you're getting your equity shares back in a private company, then you better read the operating agreement or the shareholders agreement really, really carefully, because typically in non-public companies, those types of agreements prohibit third-party transfers of equity without the agreement of the other shareholders or the board of managers if it's a limited liability company. And some don't allow transfers at all without complicated rights of first refusal and all of this other stuff. Even if it has some value, if you can't sell it because the restrictions don't allow you to sell it, then what have you got?
Yeah.
So It's not my favorite way to go, but if it can facilitate a deal, it's certainly worth talking about.
Yeah, that's a good point, Larry. One of the things we tell clients is in that situation, it is a private stock, but you might get 10% of something that is going to be sold down the line to a PE or a strategic, and you get 10% of 100 million. By virtue of that, the hold is long because you have to wait for that to happen, and it's not a public market. So the wait on that, and it's not guaranteed that will happen, but that's the upside as to why that might be appealing to folks as an overall component in a deal.
Okay. Let's say before I forget, if anyone's listening and has any thoughts or questions or comments about what we're talking about or anything that we're talking about, you can send us an email at connect@mjbulls.com. And I also want to thank Jamie Humiston for composing the music for the show today. Thanks, Jamie. Larry and Dena, before we check out, last question about cash. Is it common for a buyer to say, we can give you this much at closing and we're going to give you this much in a year and this much, not based on anything, just on a payment schedule? Do you see that common in this industry?
Of course. Yeah. Well, let me say it like this. I see it, and again, in a situation where it's going to help facilitate a sale for you at a price that you're looking for. The real question, what guarantees do you have? What security are you getting that you're actually going to get paid on a going forward basis, right? If it's like, well, we'll pay you if we're successful, then you're basically in the earn-out situation again. Mm-hmm. If it's, we will pay you on a regular basis, then the question to them has to be, from what source? The business isn't going to generate that kind of cash that you'll be able to just pull it from there. Do you have a bank that's giving you a loan? Do you have a third-party investor? In other words, I would need to see something, and I would need to have some sort of a guarantor backstopping it, because that is potentially risky.
Okay. Is that what you're going to say, Dena?
Yeah, I was going to say, we see that sometimes, it usually comes in the form of a seller's note. So essentially the seller has a right of a receivable, if you will, for lack of a better word, from the buyer for future payouts. Sometimes it's asked for that to be put into an escrow, to Larry's point, to preserve those funds and make sure that they're restricted and that there's proper liquidity, or if not an escrow, some form of guarantee that, the funds will be there. And so we see that from time to time, so that for those who want to achieve a certain dollar figure, if you can't get it all at closing, but you don't want to continue on in a performance capacity, sometimes the seller's note is used. And essentially, there's usually an interest component to it as well. And it kind of compensates for that length of time that you get the proceeds versus getting it all up front.
Okay. Well, we covered a lot today in a short period of time, so I appreciate you guys sharing this information with everyone. Important stuff for our listeners, especially anybody that's in the process of making a sale. So I will speak to both of you next week, and everyone have a great week, and we will speak to you again next Sunday on Cashing Out.